The Bank of Japan scraps negative interest rates, but says it won't do too much more. So the yen fell, and so did US Treasury yields. The RBA held rates, but slightly dovishly, which pushed the Aussie dollar down. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Commodities strategist Soni Kumari looks ahead at what US oil supply growth means for oil prices.
There are 2 factors which will be important for oil prices this year. The first is definitely how OPEC is going to maintain its supply management. And the second is the slowing production growth in non-OPEC supply.
But first, in 5 and 5 with ANZ, the Bank of Japan has put an end to 7 years of negative interest rates, with its first rate hike since 2007, putting up its key policy rate by 10 basis points to 0.0%. The Bank of Japan replaced yield curve control with a program to buy Japanese government bonds to keep its balance sheet the same size, and also ended purchases of exchange-traded funds. The Nikkei rose nearly 0.7%, while the yen weakened. More on that soon. ANZ senior international economist Tom Kenny says while the day was historic, the main news was the BoJ's guidance that it will be some time before rates rise again.
With respect to inflation expectations, he mentioned that they were a long way or some way from sort of generating consistent 2% inflation over time. So I think that the Bank of Japan would be looking to keep inflation going for some time before trying to hike. And secondly, he mentioned that there was a possibility of another rate hike if there was a big upswing in prices. I think here he said the risk of that event occurring was pretty low.
Number 2, Tom says the dovish tone to future guidance caused the yen to weaken, with the US dollar yen trading this morning up 1.2% at 150.94 yen to the dollar. For more on the outlook on the yen, here's ANZ FX analyst Felix Ryan.
Ultimately, it's the lack of certainty around future hikes by the BoJ and the soft Japanese economic backdrop will mean that today's hike won't be much of a headwind at all for the dollar-yen exchange rate. Really, for the dollar-yen to move lower, what we need to see is lower US yields, and that will really depend on what the FOMC does this week and into the future.
Number 3, global markets have digested that dovish guidance overnight, with US Treasury yields down about 3 basis points at 4 a.m. Sydney-Melbourne time. The S&P 500 was trading up 0.3%. The focus in the US and around the world now is on what the Fed's Open Markets Committee will do tomorrow. Here's ANZ Head of G3 Economics, Brian Martin.
That view that Japan is going to be moving gradually, that just fed into a bit of yen weakness, and I think fed into a bit of a relief in bond markets as well globally. So that's why we've seen US yields come a touch lower today in front of the FOMC meeting tomorrow. So for markets, they are still hesitant as to when the FOMC will begin its rate cutting cycle. They're about 60% priced for a 25 basis point cut in June. They are fully priced for a rate cut in July.
Number 4, the Reserve Bank of Australia yesterday held its cash rate at 4.35%. Now that was expected. ANZ Head of Australian Economics, Adam Boyton, says traders saw the RBA's commentary as more dovish. The Aussie dollar is down 0.5% at 65.28 US cents at 4 a.m. Sydney-Melbourne time. The Kiwi is down 0.5% as well at 60.49 US cents. Here's Adam on the RBA's language.
There was a move almost to neutral, actually, just given the way that phrase from February, quote, a further increase in interest rates cannot be ruled out, end quote, was taken out. But what it was replaced with was a statement that said the board isn't ruling anything in or out. My view is there's a very, very mild tightening bias there, but the bank is evolving, and I do think that by the time we get to the next meeting in May, we'll be neutral and there'll be no tightening bias.
Number 5, Adam still sees the RBA cutting from November.
The RBA will want to be really confident that inflation just hasn't gotten back to target for 1 or 2 quarters, but is getting back to target or has gotten back to target and is going to stay there. And then around the middle of the year, or 1 July to be precise, we do have those fairly significant stage 3 tax cuts. And I think the Reserve Bank will want a little bit of time just to see how they percolate through the economy. On our estimation, those tax cuts are probably worth about 225 basis point rate cuts. So they're not immaterial. But what it does mean, I think, is that this year in Australia, there will be policy easing. It'll just be fiscal policy first and then followed by monetary policy toward the end of the year.
Adam Boyton there. Now, in today's bonus deep dive interview, ANZ Commodities strategist Soni Kumari looks at how non-OPEC oil production will affect oil prices this year, especially with US oil output at record highs, even though oil rig counts are falling.
Well, this was surprising for us as well, but the rig counts have fallen 19% over last 12 months. Still, production has been hitting record high, above 30 million barrels per day. And this can be attributed to, few factors like improved well productivity and the lag effect of previously strong drilling activity, which we had seen when prices were rising quite strongly. Further, oil production can not only occur after drilling, but even after cementing, fracking, testing, and completion, which lags production by as much as 9 to 12 months. However, the main driver was an increased focus in more oil-rich basins, such as Eagle Ford and Bacon, and both these basins achieved production rates between 1,400 to 1,700 barrel per day. And this compares with the rate of 300 to 1,000 barrel per day in other oil basins.
So can we expect them to keep this production this high, or is it going to taper off as those rig counts come down?
We expect that the productivity gains, what we had seen last year, it will slow down, and the falling rig counts, now it has fallen below number of rig counts which are required to maintain the current production level. So we expect that the production level will struggle to maintain at the current level, and in the coming months, mainly in the second half of this year, the production rate is going to slow down. So last year we had seen 1 million barrel per day of production growth coming from US, but this year we are just expecting 300 to 400,000 barrel per day of production growth in 2024.
What do you think this means for non-OPEC supply and oil prices in general over the next year?
Non-OPEC supply growth exceeded 2.1 million barrels per day in 2023, and this has been a key drag for oil prices since second half of last year. Though non-OPEC supply is still remaining strong, we expect supply growth to slow down this year to 1 million barrels per day. And this slowdown is largely coming from US oil production. And since the prices are also not at a super high level, the companies will continue to adopt a tight fiscal discipline to invest in the oil sector, and that will keep oil supply growth from non-OPEC to slow down in 2024. There are two factors which will be important for oil prices this year. The first is definitely how OPEC is going to maintain its supply management, and the second is the slowing production growth in non-OPEC supply. We had seen a very strong supply growth coming from non-OPEC, and now it's reducing to half of the production growth. So that will play a very important role supporting the oil prices in 2024. We expect oil price to trade in a range of 85 to 90 in this year. Though it looks sideways view, but we maintain our positive bias for oil.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 20th. Catch you tomorrow with the latest from the Fed. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.